The U.S. housing market crash of 2007 to 2008 was one of the most significant financial crises in modern history, with far-reaching implications for the global economy. At the center of this crisis was a boom in subprime mortgage lending, which allowed borrowers with poor credit to take out loans they could not afford. As home prices began to decline and borrowers defaulted on their loans, the housing market collapsed and many financial institutions were left holding worthless assets. One investor who saw the risks in the U.S. housing market and capitalized on them was John Paulson, the founder of the hedge fund Paulson Co. In 2005, Paulson began buying credit default swaps on subprime mortgage bonds, effectively betting against the housing market. When the market finally crashed in 2008, Paulson's bet paid off handsomely, earning his firm billions of dollars in profits. John Paulson's bet against the U.S. housing market is an important topic to discuss for several reasons. First, it highlights the importance of risk management and the ability to identify and capitalize on emerging trends in financial markets. Second, it serves as a cautionary tale about the dangers of speculative bubbles and over-leveraged markets. Finally, it raises questions about the ethics of profiting from the misfortune of others, as Paulson's bet was essentially a bet against homeowners and investors who had taken on too much risk in the housing market. Overall, John Paulson's story offers valuable insights into the workings of financial markets and the strategies used by successful investors. John Paulson is an American investor and hedge fund manager who gained international recognition for his role in predicting and profiting from the U.S. housing market crash in 2008. Born in Queens, New York in 1955, Paulson attended New York University and graduated with a degree in finance. He later earned an MBA from Harvard Business School in 1980, where he graduated with high honors and was named a Baker Scholar. After completing his MBA, Paulson worked in a number of financial institutions, including Bear Stearns and Gruss Partners, before founding his own hedge fund, Paulson Co. in 1994. At the time, the fund was a small operation with just $2 million in assets under management. However, Paulson quickly gained a reputation for his skill in identifying and exploiting market inefficiencies, and by the early 2000s, Paulson Co. had become one of the largest and most successful hedge funds in the world. Paulson is perhaps best known for his prescient bet against the U.S. housing market in 2005 to 2008. Recognizing the risks posed by subprime mortgage lending and the growing housing bubble, Paulson and his team at Paulson Co. invested heavily in credit default swaps on subprime mortgage bonds, effectively betting against the U.S. housing market. When the market eventually crashed in 2008, Paulson's bet paid off, earning his firm billions of dollars in profits and cementing his reputation as one of the most successful investors of his generation. Today, John Paulson is considered one of the wealthiest men in the world, with an estimated net worth of over $4 billion. In the early 2000s, the U.S. housing market was booming, with home prices rising at an unprecedented rate. This was due in part to a combination of factors, including low interest rates, lax lending standards, and the increasing availability of subprime loans. Subprime loans were loans given to borrowers with poor credit histories, often with high interest rates and adjustable rates that would increase over time. Lenders were eager to give out subprime loans as they could earn high fees and commissions on these loans. At the same time, borrowers were eager to take out these loans as they could buy homes they otherwise couldn't afford. This led to a surge in demand for homes, which in turn drove up home prices even further. As the housing market continued to boom, more and more people got caught up in the frenzy. Many buyers purchased homes with little or no money down, taking on large amounts of debt in the process. Lenders also began offering more and more exotic loan products, such as interest-only loans and option-adjustable rate mortgages, which allowed borrowers to make smaller payments in the short term but left them exposed to increasing payments and interest rates over time. By the mid-2000s, the housing market had become over-leveraged and unsustainable. Home prices began to stagnate and even decline in some areas, leaving many homeowners with mortgages that were worth more than their homes. As borrowers began to default on their loans, a housing market collapsed, triggering a financial crisis that would have far-reaching implications for the global economy. John Paulson and his team at Paulson Co. were among the few investors who recognized the risks inherent in the U.S. housing market in the mid-2000s. They saw that the housing market was over-leveraged, with many buyers taking on more debt than they could afford. They also saw that lenders were offering subprime loans to borrowers with poor credit histories, and that these loans were being packaged together into complex financial instruments called mortgage-backed securities, MBS, and collateralized debt obligations, CDOs. To profit from their insights, Paulson and his team decided to bet against the housing market by purchasing credit default swaps, CDS, on subprime mortgage bonds. A CDS is a type of insurance policy that pays out in the event of a bond default. In this case, Paulson Co. was essentially buying insurance on subprime mortgage bonds, betting that they would default and trigger a payout. As the housing market continued to deteriorate, Paulson's bet began to pay off in a big way. By the end of 2007, Paulson Co. had earned billions of dollars in profits from their CDS positions, and they continued to reap rewards as the market continued to decline in 2008. Paulson's bet against the U.S. housing market is widely regarded as one of the greatest trades in financial history. Not only did he and his team correctly identify the risks in the housing market, but they also had the foresight and conviction to bet against it at a time when few others saw the danger. The success of this trade made John Paulson a billionaire and established him as one of the most successful investors of his generation. The U.S. housing market crash of 2007 to 2008 was a catastrophic event that had far-reaching consequences for the global economy. The collapse was triggered by a combination of factors including lax lending standards, subprime mortgage lending, and a speculative housing market. As borrowers began to default on their loans, the value of mortgage-backed securities plummeted, leading to widespread losses for investors. As the crisis unfolded, it became clear that many banks and financial institutions were heavily exposed to the subprime mortgage market. In an effort to shore up their balance sheets, many of these institutions began to sell off assets and reduce their exposure to risky investments. This triggered a downward spiral in the financial markets as investors became increasingly nervous about the health of the banking system. The crisis soon spread to other parts of the economy as consumer spending slowed and businesses struggled to access credit. Unemployment rose sharply, and many people lost their homes as the foreclosure crisis deepened. Governments and central banks around the world intervened in an effort to stabilize the financial system and stimulate the economy, but the recovery was slow and painful. Overall, the U.S. housing market crash of 2007 to 2008 was a stark reminder of the dangers of speculative bubbles and the importance of strong regulation in the financial industry. It also highlighted the interconnectedness of the global economy and the potential for financial crisis to have far-reaching consequences. John Paulson's bet against the U.S. housing market turned out to be one of the most profitable trades in financial history. By betting against the housing market with credit default swaps, CDS, Paulson Co. made huge profits when the market crashed in 2007 to 2008. Paulson's team started buying CDS on subprime mortgage bonds in 2006, and by the end of that year, they had made around $3.5 billion in profits. In 2007, the profits from the CDS positions skyrocketed, and Paulson Co. earned a staggering $15 billion in profits. By the end of 2008, the total profits from the bet reached $20 billion. The success of the trade made John Paulson a billionaire and established him as one of the most successful investors of his generation. It also helped to cement Paulson Co.'s reputation as one of the top hedge funds in the world. While Paulson's bet against the U.S. housing market was controversial at the time, it is now widely regarded as a brilliant example of contrarian investing. By betting against the market when most investors were bullish, Paulson was able to capitalize on an opportunity that others had missed. The profits from the trade also helped to cushion the blow of the financial crisis for Paulson Co., allowing the firm to weather the storm and emerge as one of the biggest winners in the aftermath of the crash. Despite the immense success of John Paulson's bet against the U.S. housing market, it has also been the subject of criticism and controversy. One of the main criticisms leveled against Paulson is that he and his firm profited from the suffering of others. By betting against the housing market, Paulson essentially made a bet that millions of people would lose their homes and that the economy would suffer a severe recession. This has led some to question whether it is ethical for investors to profit from the misfortune of others. Another criticism of Paulson's bet is that it contributed to the severity of the financial crisis. Some argue that the massive profits earned by Paulson Co. and other hedge funds that bet against the housing market encouraged further speculation and risk-taking, exacerbating the systemic risks in the financial system. There have also been questions raised about the legality and transparency of the CDS market. Critics have argued that the market for CDS was opaque and difficult to regulate, creating opportunities for insider trading and other unethical behavior. Despite these criticisms, it is important to note that Paulson and his team were not the only investors who saw the risks in the U.S. housing market and bet against it. Many other hedge funds and investors made similar bets, and some even lost money in the process. Additionally, Paulson has been involved in philanthropic activities and donated significant amounts of money to various causes. Ultimately, the debate over the ethics and impact of Paulson's bet against the housing market will likely continue for many years to come.